Hello, this is John Kicklighter, Global Head of Content for StoneX, here to discuss the heightened volatility that we have in these global markets amid the U.S.-Iran conflict. Now, what's remarkable is when we see markets that are directly influenced by these events, specifically if we look at WTI, West Texas Intermediate crude oil, or we look at the Brent crude contract, both of them have seen enormous responses to this news. Obviously, this happened over the weekend, and subsequently we were left with a over 11% gap higher on the open from Friday to Monday. Also happens to be start of a new trading month. We would also see a surge in the implied volatility index behind crude oil, the OVX. Now, these are moves that we would absolutely expect in this kind of geopolitical uncertainty and this ongoing event with a lot of complicated considerations for the global markets. But what about the broader global market? What is remarkable is that despite this volatility, and if we look back towards historical references of outbreaks of military engagement in the Middle East, we have had a significant spillover into the traditional financial markets and broader capital markets. Yet, in this instance, we don't necessarily have that even of a distribution of impact. If we were looking at something, for example, like the S&P 500, we would see that this U.S. benchmark equity index, which is usually a leading aspect or a leading measure of risk on, risk off, it barely budged. In fact, it closed higher on the day slightly for the first session of the trading week, the first session post the news. That is a remarkable outcome, and it actually keeps this benchmark within a very tight range. In fact, this is the smallest 60-day trading range, so equivalent to 3 months or a quarter of the year, that we've seen from this benchmark as a percentage of spot since back in September of 2017. That is a persistent quiet, despite the fundamental shock that this would represent. And this is not the first one. We would also see this happen with the tariffs and SCOTUS determining that the U.S. president didn't have the ability to apply the tariffs that he did following the Liberation Day variable tariff rates. And we also had a number of issues like no rate cut from the Federal Reserve in January. So there's been a number of these traditional fundamental themes that have come across the wires and have complex structures in terms of scenarios, and yet no key break or no broad break of risk trends across the board. We would even see something along the lines of the volatility index, the VIX. While it did jump to start the day on Monday, it pulled right back. This is very unusual, and it's not just isolated to the U.S. markets. We also see measures that have more of a risk orientation. Recently, crypto or Bitcoin is a lot less of a safe haven, much more of a risk benchmark. You can see that it actually, if we go in the shorter time frame, did initially have a response of some rally or restraint, but it would still stick to the broader range that we've had over the past month. So these markets are inconsistent when it comes to a risk response, and it suggests that there isn't a broad consensus of risk on, risk off. Now, when we talk about risk on, risk off, it's important to identify those types of markets and where they stand in the spectrum. I have a handy-dandy measure here. But on the more extreme ends, the things that are more speculative in nature, something like Bitcoin or carry trade, carry currencies, Aussie USD in this case, S&P 500, the high yield fixed income emerging markets measures are more on the sensitivity scale towards risk aversion. The outperformers in these kind of instances would be more along the lines of safe havens like the US dollar, treasuries, gold. And we want to monitor to see when we have that extreme alignment, because when you get that extreme alignment and you get further into the intensity of risk off, there's much more consideration for follow through. There's consistency there and there's momentum that can override some of these restraints and restrictions and preferences that we see in these risk-oriented assets. But as of right now, we have not overrode those restrictions. That being said, there still is a pullback in risk-based assets. This just isolated a little bit more towards things perhaps in the region. We have seen some of the indices and exchanges from the Middle East have remained closed given the uncertainties of the area, but it's quite interesting to see it's actually spread beyond that. We can see emerging markets, the EEM ETF had a significant gap to the downside. We had high yield fixed income, which is a much more risky type of credit in the bond markets, did have a gap to the downside, quite significant. And even rest of world equities, the VEU ETF, has actually seen a pullback of its own, much more prominent than the US counterpart. On the other end of the spectrum, we would also have gold as a safe haven, did advance, but not very strongly. All right, treasuries would actually not make the kind of move you would expect. It actually pulled back. U.S. Treasuries. This is the TLT ETF representing those. So some degree of inconsistency here in this, but it does highlight some interesting contrasts that we perhaps have been highlighting over time. For example, the S&P 500 versus VEU, that's the U.S. equity benchmark relative to rest of world equities, that sell America trade has been throttled. We would also see the dollar has also jumped quite significantly. This is the DXY dollar index. So there is, on the risk side and on the haven side, some movement. We definitely have it in the crude oil market, but we want to see how far it spreads. And these are the things we should be watching to see if there's that consistency. And the more intense that it gets, or the broader it spreads, that is going to turn less into a specific consideration of the fundamental implications, let's say downstream implications of slower growth with higher energy prices because of the close of the Strait of Hormuz, or the delay of interest rate cuts because of the uncertainties of inflation, or perhaps the complications of trade negotiations with these kind of actions. Instead, we will be looking at more of a purely sentiment-led drive. But it's going to have to be something that gets us out of that comfort zone, that reticence that we've seen from a benchmark like the S&P 500, breaking these ranges, going across capital markets, and aligning to a purely sentiment-based move. The risk is there, and it has been there for a while, but the complacency, the market's comfort with avoiding that has been even stronger. So that is what we need to keep very close eye on. So keep an eye on these markets, whether you just watch one of them or you watch all of them, because this is a very important and broad implication depending on how it plays out. Don't forget to like and subscribe for more financial market insights.